how do you decide when to sell something? That's buying is easy in this business. Selling is actually much harder.
Our structures are designed so that we mostly never have to sell, right? If we don't want to. So this is one of the reasons that our kind of digital asset fund is evergreen, right? We can, for some of these assets, like say, a Bitcoin, very hard for me to ever see a moment where I say, this is done. I don't want to own this anymore. So we can hold that basically forever, and in crypto, 5 years, say, is basically forever. Like it's long enough that I don't, there's no point in trying to speculate on what's going to be happening beyond that. And then in our venture funds, these are 10-year vehicles. We have the capacity to hold for a very, very long time there. And, I think that in general, we don't really think about selling very much. We mostly buy, enter into positions, and we want to hold for the long term.
But what happens if a certain token or protocol is not getting network effects? You've got it. Your core thesis is wrong. How do you get to the point where saying actually might be wrong, or do you just say, fuck it, we'll just hold it?
Yeah, I mean, we will exit if we feel like this is genuinely over. Mostly it's if we feel like we can't spend time on it anymore, right? I think that I don't want to hold things where I don't have a person on my team focused on that position and understanding what's happening in that business, in that ecosystem, whatever it might be. So I think it's mostly if we feel like something is failing to the extent that we just no longer have time to look at it, right? I think it's irresponsible to continue holding it if we're not going to be monitoring it. So that's really the main logic around exiting. But broadly, I think that the return distribution here is not unlike traditional venture. It's power law distributions, and what that means is like if you sell half every time it goes up by double, you're going to dramatically diminish the returns on your winning assets. And what we've seen empirically with our approach is that not unlike traditional venture, the majority of the returns are generated by a small number of investments. So it's having that long-term approach and being able to weather substantial volatility is critical, because the mistake that a lot of people make in crypto, when I first got into Bitcoin, it was going down from $30 to $2, right? And if that's not a big drawdown, right, I don't know what is. And so if you see that and you say, well, this failed, we've got to exit, you're making a huge mistake. So like price volatility cannot be the factor that is making you make those decisions.
No, because it's an exponential trend. So therefore it's risk adjusted returns. If you don't see it in that term, you shouldn't be in the space, I guess.
Yes, exactly. So weathering massive volatility, even on your winning assets, is critical. I mean, a lot of that Ethereum that I bought when we launched the fund, I mean, it went from $7 to over 1,000, down to 80, now up to 4,000. I mean, it's wild, right? But my whole philosophy from the beginning is that there's so much secular growth right here. It feels like, we had this growth like of the internet, and before that personal computing, then mobile. There's so much growth here, and the whole category is compounding so quickly. The idea that you're going to be able to trade around that type of return and beat that long only buy and hold approach, to me, it's a lot of hubris to think that, this thing that on average is compounding at, IRR of like 100% a year, right? The idea that then I'm going to call the tops and bottoms and actually get it to 130% IRR, right? I will just take the 100% IRR, right? And not try to screw it up by trying to trade around tops and bottoms. So I do think that the volatility in crypto leads a lot of people to sort of become traders, right? They think, I can protect myself with complicated hedging or derivatives. I can I'll call the top and buy back lower. I'll use leverage at the bottom. Lot of things like that I think are in a sense psychologically tempting for people, but it's empirically over a long term horizon. It just feels short-sighted to try to beat, the secular growth here and this kind of pace of technology development in this category.
Yeah, I totally agree. This is the reason I don't look for any yield, because a 100% return to get a 10% yield, I'm like, most of these things go up and down 10% in a day. So I don't think you get compensated for the risk in yield. So I've always kept away from yield just from that same thesis. And, I also don't trade it. I don't sell it, don't do anything in it. I just keep the position and hold it for as long as possible. I was looking at the numbers on this and just updated it last week, is that the crypto wallets and active addresses are growing at 185% a year, which is still twice the speed of the internet. So what we did is we took both the internet and crypto with 5 million users, when they both got the same age, put them on the same axis. I mean, crypto is twice the speed of adoption. We've literally never seen a technology be adopted this fast.
Yep.
And the people forget exponential numbers because we're at 300 million users now. If we go up just 100% next year, it's 600, and then it's 1.2 billion.
Yes, exactly.
You're half the world by the end of the decade.
And I just I've been on the front lines of this for so long, and I've watched it grow at this pace that the entire time it felt like a unreal, just how fast this has grown and how much it changes every year. Every year in crypto just feels like we're in a completely different industry all over again, and the amount of shakeup there is every year in who the leading players are and everything. It's wild to me. And so being able to be patient in a category that's this fast moving, and being able to weather volatility in a category that's this volatile, I think is often a superpower, even though it in a way is the easiest thing to do. In theory, the easiest thing to do is buy and hold and be patient. The reality is a lot of market participants, I think, they can't handle the speed. They change their thesis every 6 months on what's going to happen. And they get caught, as I said, getting involved in basically trading, hedging, et cetera. And they're missing the forest for the trees. So we've always just taken a very patient, long-term approach. And I think it's hard to beat that.
Yeah. Question is how do you get your investors across the line? It's all right for you to take the long-term, we'll take the volatility approach. Investors always say, yes, we understand. And as soon as you're down 50%, they're like, I've got to get out.
Yeah. I mean, we've, luckily, I say this a lot. So everything I'm saying here, I say to all of my investors all the time. I remind them of my view, and I remind them that my view is really not going to change, right? We're not going to see a 50% drawdown and all of a sudden, we're long short, right? My view is going to stay the same. And until I have like a really big change in thesis, right, we're never going to change the approach, right? And the thesis so far has played out correctly. And I don't see any indication that core thesis that really I launched Polychain with is changing. I actually think the probability it plays out from here is much higher than it was when I launched Polychain. It was a much more insane concept at the time 5 years ago. So to me, it's reminding investors. And then at the same time, it's setting up your fund structure, right, to mimic the asset class you're participating in and mimic sort of the investment approach. You want to make sure that the sort of liquidity rules of the fund, match the approach and the strategy, right? So I do think, for example, with managers, it can be tempting to make your fund really, really liquid and then your investment strategy illiquid, right? Which nobody wins in that scenario, but it can be tempting as a fund manager to go down a path like that in order to raise capital. But I think, we've been very careful about making sure our funds kind of mimic the investment strategy.
Yeah, it's interesting because I launched this fund of fund business, and we had two share classes. One is a 1 year lock and one is a 3 year lock. 95% of people choose a 3 year lock, which is quite rare in other parts of the fund industry, because people are learning that they are their own worst enemies and they need to be stopped from doing the wrong thing. They just need to close their eyes and let the process play out.
Yeah. And at this point, we have a long enough track record through, multiple cycles where I think empirically, a lot of the things that I'm saying here have proven to be true, right? It was kind of a theory or speculation or my thesis. Now I think we have a lot of numbers to back it up.
So now we're in the midst of a large drawdown in crypto assets, and I presume you're having a drawdown along with the market. What do you think? Do you start trying to get people to put money into this? I mean, these are the times. Now, whether it goes down another 20%, it's irrelevant, right? But this is what you look for, because this is what drives returns, is your actual entry price. That's really what's driven your returns so well, is you've been really early in things at good prices.
Yep. So we definitely try to, we try to get, more and more aggressive the worse and worse it gets. Right. I think if I've had one, again, like I don't pay that much attention to the market cycles or what the weekly price is. But, I am extremely aggressive in the depths of the bear markets. Right. And it's when everybody is doubting everything that I see the most opportunity. And it's when we've made a lot of our very best investments. So, broadly, I just stay the course and get, aggressive. Like when I see, these crazy things, like I remember the suicide hotline being posted on the Bitcoin forums. It's like, oh my God, when you see something like that, of course I feel for everybody that, got overextended in that moment. But at the same time, I'm like, this is crazy. Like this, it's not going to stay like this. And so when I see, these crazy indicators like that, it just feels like, okay, now is the moment to bet on things that nobody else is willing to. And that's making multi-year bets on the most speculative technology plays in the moment when people have the biggest doubt, even about the things that exist today.
So at this point, everything's further out the risk curve has been absolutely destroyed in price. Nobody wants it. And at that point, you're going to sift through the wreckage and see if there's anything interesting. So we're not talking about stuff that's not launched yet. You're talking about stuff that's out already. So tokens that are trading?
Really both. But especially the far out, like sci-fi tech plays are the things that get the most pain, right, in the bear markets. And that's when I like to go very aggressive in, okay, let's make the big bets right now that we know are going to take 2-3 years at least to play out. And so it's in those moments when I see a lot of opportunity to make the most risky bets.
So I know you're not a trader, so I don't want to talk too much about markets, but where do you think we are now in terms of, feels like the market structure's changed to me, but I don't really know. And again, doesn't really matter because I don't trade it either. But what is your thought where we are now? Are you getting a sense that this is a capital deployment opportunity, or is it just a we'll see how it goes opportunity?
The sophistication around the crypto market has improved so much over the last 2 years, right? The market makers that have gotten very serious and are in the space, the quality and reliability of all the exchange platforms, all of the institutional tooling that allows larger and larger amounts of capital to get into the space, these have all improved on an exponential curve over the last several years. At the same time, the tech development here is, it's just bigger than ever. Trying to track everything that's happening in the really kind of crypto hard tech space is near impossible at this point. The number of breakthrough papers that come out, the number of new financial protocols, new sort of like software, protocols designed for deploying applications. It's a breakneck pace, and it's only accelerating. And then in the meantime, the retail kind of hype-driven market has come off. So you see all of these, for example, NFT projects that, from my vantage point, are clearly just sort of money grabs by the creators, et cetera. You see the wind come out of the sails on the macro retail market, but at the same time, you see increasing access of institutional capital, and you see this sort of fundamental improvement in the technology and all these new business models. So that to me is the best time to get involved, right? You see this divergence between the fundamentals and just the market price, which to me is kind of what we're seeing right now. And, I hold your view that I don't try to predict the future. I don't try to say, well, is it going to go down more? Is this the bottom? Whatever. It's more that, I see a divergence, right? Like prices are lower than they were last May. And yet there's been so much fundamental progress since last May. So you're just getting a better deal today than you were getting back then.
And one of the things is we've obviously seen 32 billion go into VC in the space last year, which has distorted a reasonable amount in pricing. We're seeing things like stuff, whether you like it or not, but stuff like, let's say, internet computer fall 95% or 90% as soon as it goes into the secondary market. There's a big mismatch in pricing between the two. What do you think? I mean, my thesis is, yes, there's probably money being put into wrong projects in VC, but overall, give us another 3 years and we're going to have an incredible amount of innovation coming out. How are you thinking through this whole VC cycle?
I agree with that. I think, broadly just more capital is going to spur more R&D, more experimental business models. It allows founders to go, as you put it, kind of further out on the risk curve with their experiments. At the same time, I do think that I worry, I guess, that a lot of VCs and capital that are entering the space now are opportunists, that are somewhat tourists and maybe just really don't understand what's going on very well. I mean, I've seen this in crypto forever, is people that basically see money being made, so they jump in and they kind of think they know what they're doing, but they don't. And that's a very dangerous place to be. And you see projects get funded that, it's remarkable they got funded in the way they did or at the price they did. So I do think it drives basically just a lot of noise. I do think it takes a while for those new firms and new investors that don't have the familiarity with all the dynamics in the space, all the existing players, all the technology. It takes a while to get up the curve, and I think mistakes are made while getting up the curve, and it does lead to a lot of noise, weird pricing, hype, and things like that.